Alright, so today one of the things we're going to cover is options. I always get a lot of people hitting me up about options. They say what exactly is an option and how do options work, right? So when it comes to options, there's two types of options, right? You have call options and then you have put options, right? So when it comes to call and put options, the way I like to remember it is, I play little memory games, is you call up somebody, right? And then you put down somebody. So call options are used when you think a stock is going up. Put options are what you buy when you think a stock or an option is going down. Now, options are related to stocks because they're derivatives of stocks, right? So they actually are based, or the way my system goes is I base my options price off of stocks, but I base how I get in and out off of out of options. I base how I get in and out my options off of the stock price is what I'm trying to say, right? So we know for instance, if we have a situation where we have a stock that's $20, right? And we're talking about puts right now. So we have a $20 stock, and we'll say I'm guesstimating, with my educated guess, I'm guesstimating that I think it's going to go down, right? So what I would do is I would purchase that put, and I would purchase it at $20. What I would do is hope that my educated guess worked, and then when that stock made its way down to 15, I would have made, basically in terms of options, I would have made a $5 profit, right? So let's put $5 right here. So the way that you look in an option is options, right, are one stock times 100. So an options contract is actually 100 stocks, right? So the way that you look at when you have an options contract, let's make sure the right contract here so we know. When you have an options contract, what happens is our contract of 100 stocks, when we made this $5 profit, the way that it works is we take that $5 profit and we times it times our 100 stocks, which means we made $500. And that right there is how options work. That's how you can that's how basically you can make money in multiples of 100 when you're dealing with options, and that's one contract. So for instance, if you bought an options contract, let's erase all this, because when you purchase options, what happens is you got to purchase what they call a premium. The actual stock, that might be too high. We'll do stock right here. Option. Okay. So I'm going to show you the price differences when you're purchasing a stock versus an option. If you have a stock, we'll just make up a stock. We'll say it's a company called Nick Jr. Ticker symbol NCJ, right? And we'll say that stock costs you $10. Okay? So we want to buy 100 of those. Just guessed it. I'm just making up a hypothetical number. It's going to cost us $1,000 to buy that in the stock form. When we go back and we want to purchase it as an option, well, we know our options, our one contract is going to be worth 100 stocks. Right? So what happens is most companies, they like you to buy options. So what they do is they try to say, let's do a deal. And what they do is they'll say there's something called a premium. So let's say if you want to own those 100 stocks, how about this? We'll actually charge you, we'll give you temporary ownership of those stocks. So you got to pick which month that ownership would end. And each month that ownership ends, so you have a options chain. That's when you start seeing the January, February, March, different options for different months. And what happens is each month is going to be a different price. So the further out, each option will probably be more expensive because you're holding on to it longer, which means in theory, in potential, you'll make more money, right? So what they'll say is, all right, if you want to buy, we'll say, what are we in? December. We'll say we want to buy a February NCJ stock, right? So it's going to be February 2021. Let's write that right here. Feb 2021 NCJ stock. And we'll say for the February portion on that chain, what's going to happen is we'll say they're going to charge you $550. So we're going to charge you $550 for the premium, right? And I'm just totally making this number up. So we're going to charge you $550 for the premium. And when you pay that $550, you will be able to hold those 100 shares till February 21st. So it's temporary ownership to hold it till February 21st. If I have 100 shares, that means basically I'm hoping that I make at least $5 at the least by February 21st, 2021. I hope that I make at least $5 to make up for the difference between these, right? But what happens is you are already ahead of the game because you paid $550 for 100 shares, whereas when you bought the actual stock, you had to pay $1,000, right? Now, the benefits of owning the actual stock for $1,000 is you own the stock for until basically you decide to sell it. With the pros and cons, the con part about the option is you only get to make that money that you expect to make up until February 21st that you actually bought that option in that options chain. I'm hoping that's making sense. Options, you could spend hours on trying to explain this. I'm trying to just kind of break it down to you, the difference between stocks and options, and why you'll have a lot of people making a lot more money off of options than stocks, just basically depending on how they trade. I guess there's some people that make more money off of stocks and options too, but it just depends on, like I said, how you trade. So